Hey folks, welcome to a product review at Finominal. Today we're going to look at 4 deep value ETFs. And the way we define deep value is by looking at the underlying portfolios, measuring the median price to earnings and price to book multiple, and selecting the ones that rank very low on these multiples. And that gets us these 4 products from Vanguard, Invesco, Alpha Architect, and Roundhill. We're also going to add a 5th product, which is more like a kind of like benchmark from our perspective, which is the MSCI US Value Factor Index. So let's kick off in terms of seeing how similar or different their portfolios are. And what we see is that there is a large discrepancy in the sense that the product from Vanguard has about 629 stocks compared to much more concentrated portfolios from Invesco or Alpha Architect with approximately 50 stocks. As a consequence, the overlap between those products is fairly low. So here, for example, you can see the overlap compared to the product from Vanguard. You can see the highest one is 22%, which is the product from Invesco. The kind of like passive benchmark from MSCI, the Value Factor Index, is 25%. So the overlap is quite low as expected. We can also look at the top 10 stocks, which is quite diverse. We do see GM is the #1 holdings. We see CVS, AT&T, Cisco Systems, which is ironic because Cisco Systems 25 years ago was the equivalent of NVIDIA today and was anything but cheap. But that's how the world can change. So it's with regards to looking at the underlying portfolios, and we can complement that with a kind of like style analysis. So here we see the portfolios compared to the S&P 500 on a number of fundamental metrics. We do see that all of them are cheap and small in terms of the stocks within those portfolios compared to the S&P 500. The portfolio from Roundhill, kind of like purple dot, is below this one. We do see that from a growth perspective, almost all of them are kind of like low growth in terms of sales, low growth in terms of EPS. We can see that they're a little bit undifferentiated from a momentum perspective, but they are all quite volatile stocks, as expected for value stocks. And from a quality perspective, some differentiation here, right? But the majority of the deep value ETFs feature lower quality, which again is expected. The one product that differentiates itself here slightly is a product from Alpha Architect, because that from a growth perspective is much more favorable. So the portfolio is very similar to the average stock in the S&P 500. We can also see that it does actually have a slight tilt towards profitable companies. And we can explain that by Alpha Architect selecting stocks that are not only cheap, they use EV/EBIT as a valuation metric, but also looking for quality characteristics. Now, we can actually investigate that and complement that with a returns-based factor exposure analysis. So here we're using the returns over the last close to 7 years. We do see that the majority of the risk and return is driven by simple exposure to the market, because these are smart beta long-only products. We do see, of course, the high exposure value factor. But again, we see that Alpha Architect's product, right, is kind of the only one that has a positive beta to the quality factor. It does have, stocks do tend to be more volatile, right? But it also has a slight tilt towards momentum. So this is, of course, where you can select products, right, based on just being cheap, right? Or being cheap and having momentum, being cheap and having quality characteristics. Now, let's look how that translates into risk. And we're going to look at the drawdowns those 4 ETFs had, as well as that kind of passive benchmark, the MSCI Value Factor ETFs, during periods of market stress. What's kind of interesting is that if you look at the market downturn in 2022, that almost all of those 4 ETFs had a drawdown that was slightly better than that of the MSCI US Value Factor Index. But during COVID, it was significantly worse. So there is no consistency here, right? It does seem to be, there is a consistency that they either are better or worse than the passive benchmark, but there's no consistency among any of those products being consistently better or worse from a drawdown perspective, which is interesting to think about. And it does highlight, that there is, of course, despite the portfolios being slightly different from fundamental metrics, there are, of course, some similarities. In a sense, they are all comprised of small and cheap companies. Now, from a return perspective, we do see that the product from Vanguard has outperformed in the period since 2018. Versus the product from Roundhill has significantly underperformed. Having said that, we also do have to acknowledge that the outperformance of the product from Vanguard was not consistent. It kind of performed more in line until 2021, and then it started outperforming. The product from Invesco, the QVAL ETF, as well as an Alpha Architect, kind of performed in line with the MSCI US Value Factor Index. Now, so we looked at risk, we looked at return. We can also, of course, look at both in a combination. We do see that all of those four products are quite high in terms of volatility, which ranges between 21 and kind of 27%. In contrast, the volatility of the S&P 500 is lower than that. S&P 500 is also, of course, much more diversified, right, with 500 stocks, at least than some of these products. What's surprising here is that if you look at the volatility of Vanguard's product with 629 underlying holdings is almost the same as a product from Alpha Architect with 50 holdings. And so that's interesting. In Alpha Architect, there's equal weight and it has that quality tilt, right, which tends to decrease the volatility, right? So you don't necessarily need to be very diversified to lower your volatility. You can also achieve that with other means. Having said that, from a kind of like risk return or Sharpe ratio perspective, these products are kind of similar, except the one from Roundhill. Roundhill's Sharpe ratio the last 7 years is 0.13, so that clearly is unattractive. The other products range between 0.29 and 0.38, and are quite similar from that perspective. So that kind of like summarizes our review of these four deep value ETFs, as we've seen from a fundamental perspective, right? The portfolios of the underlying stocks overall are quite similar, right? But there is a bit of differentiation between each of those ETFs. If you look closely, there's no strategy that is clearly superior. So it kind of boils down a little bit in terms of investment philosophy and largely, of course, factor performance. Now, none of these products will perform if the value factor itself performs negatively. And this, of course, applies to all single factor or multi-factor products that the fund manager can provide exposure to a factor, but they have no influence over the factor itself. Hope that helps. Have a nice day.